All right, so what's going on, guys? This is Rod from Rod Capital. A lot of people have been asking me to make a breakdown of some of my plays that I've been taking. Today we're gonna go over my Tesla play that I did Monday. I made 7.7K on that play. Now this was a swing play, and I'm going to show you my ideology behind why I did what I did. So we're going to switch over to Thinkorswim. And as you can see in the top, I'm actually using On Demand. On Demand is a feature that Thinkorswim allows its users to use. You can go back and you can reenact the previous trading days in the past. I think it's like you can go back as far as, I don't know, you can go back a while, but you have to give it like 3 days from the present day. So I wouldn't be able to replay yesterday's action or Tuesday's action. Today is the 6th of February, so it's Thursday. But luckily we can catch the Tesla play that I did Monday. So here we are with Tesla. I got it started up at 9:26, February 3rd, that Monday morning. Now I just want to show you guys here. Let me move this over here. So I'm using the TTM squeeze indicator. TTM squeeze indicator was a indicator that was created by Dr. John Carter. And basically what it is, if you're not familiar with the TTM squeeze, the TTM squeeze takes the Kettler channels and it basically gives us a better visual of what's going on within those Kettler channels. So people are like, well, what are Kettler channels? Well, a stock tends to, have certain types of movements, right? It'll trend in a direction. It'll consolidate, which is basically, it's just not really moving at all. And it'll break out of a consolidation or break out of a trend or whatever have you. Well, Kettler channels is like a range that stock tends to trade in. And as long as that stock trades within that range, it's basically building up energy, right? Because stocks need to move in a direction typically. So the longer that stock moves in that Kettler channel, it's just building up momentum, it's building up energy. And here you can see these red dots that lets us know that that particular stock is trading in that Kettler channel. Well, stocks don't typically trade in Kettler channels for too long. Now, when I say too long, there's different time frames, right? It could trade depending on the time frame that you're looking at. Right now, I have the 1 hour chart pulled up. It's going to trade in that range for, let's say a couple of hours. Well, let's say if I was trading we was looking at the daily time frame, it could be a couple of days. If I was looking at it on the 4 hour time frame, it could be, a lot longer, and so on and so forth. But the important part that you need to know and understand is that when you see these red dots, that means that the stock is trading within that range, and sooner or later, you're going to get a bigger than expected move. Now, bigger than expected move is very important because the premium that you're buying, which means the contract that you're purchasing, is going to be relatively cheaper than what it would be outside of this range. Now, why is that? Well, volatility plays a part of this. When stocks are trading within that Kettler channel, that range, volatility is relatively low, which means the price that you're going to be paying for these contracts are going to be cheaper than what they would be when the stock moves away or out of that Kettler channel, right? So basically, we're buying low, we're selling high. Here, we're going to back up. This was that Friday. So here you can see, So here's the Friday. You can see that Tesla went into a squeeze here, right? And it continued to squeeze throughout that day. And here we are. See, we're about to start. I'm going to press play. And we're we're going to reenact what happened. But basically, I took this swing Friday afternoon. I saw that we were consolidating relatively hard, and I took a gamble. It was a gamble, right? Because it could have fired to the downside, it could have fired to the upside. I didn't know. What I did know was that Tesla had a lot of news, a lot of positive news, and so I made an calculated calculated decision to play calls, and it worked out pretty nice in my favor. So here you can see the 1 minute time frame. We have Tesla gapping up that morning. This is Monday morning. So here we can see Tesla was trading in that Kelly channel, was trading that range, and it exploded out. The green dots indicate that the ticker is no longer in that Kelly channel. It has moved away, or it has moved out of the Kelly channel. So this is what we got. We got an explosion out of that range. As you can see, we broke this very important level of 661, 662. Tesla actually went up about $100 and so that day. So it was a very big, unexpected move. I think everyone can agree. This just happened to be a time where it worked out in my favor. I mean, I've done this plenty of times where I'll jump in when I see a squeeze. And as long as, the charts are looking good, the market's moving decent, I'm not worried. This is more of a swing play. You can even do a straddle on this. So that the straddle would be, you could buy a at the money call and at the money put. And you go, well, why would you do that? Well, we're expecting a greater than expected move, right? So you buy a call, you buy a put at the same time, or whatever have you. The stock's going to make a move in either direction. Now, your job is to sit there and to see where that direction is. So let's say I would have bought a straddle on Tesla and it moved to the upside like this, right? You want to be able to cut that put in time so that you're still getting some of your money back from the put. So like you don't want it to go to zero, while your call is gathering all of this premium, right? So you don't know which way it's going to fire. You don't know which way the squeeze is going to fire. You just know it's going to fire. So you could do a straddle. As long as you cut it off in time, you'll still save some of your premium from whatever call that didn't work out, and you'll absorb all of the premium that the stock is moving in the direction that it is moving, if that makes sense. If it doesn't, I'll make another video on the straddles, on how to use straddles and squeezes to your advantage. This could be a bread and butter play for you. Like literally, I pay my bills off of these moves, guys, like every month. It never fails. So here we're at 929 at the open, and market just open. And let's look down here on the 1 minute chart. I do a lot of tape reading, seeing the orders that are coming in. That's essentially all that trading is just supply and demand. So here we can see that Tesla is still releasing from its squeeze, and a squeeze typically lasts 8 to 10 bars, guys, typically. So if you're trading on an hourly chart, that means it's 8 to 10 bars, which is 8 to 10 hours. You're trading on the 4-hour chart, it's 8 to 10 histogram bars. You're trading on the daily chart, if it's releasing from a daily squeeze, it's 8 to 10 days. On the monthly chart, something's releasing from a squeeze, it's 8 to 10 months, and so on and so forth. So as you can see, Tesla's already up about $30 pre-market, right? And it's not even a minute in, it's a minute in to the session. So as you can see how I made 7.7K on a swing play. I was very fortunate in this move. These moves don't happen all the time, very rare, but when they do happen, you want to make sure that you execute. All right, guys, it's Rod coming to you from Rod Capital. You have any questions, hit me up on IG, or if you're in Discord, hit me up in Discord, guys. Hope you enjoyed.